Ever ponder why the wealthiest individuals on the planet lawfully pay so little in taxes? It may sound unjust, but it's a set of guidelines they follow that anybody can follow. It's not magic. We'll explain in plain English how it operates in this video. It is crucial that you understand this before we begin. I am neither a tax expert nor a financial advisor. This video is intended solely as an instructional tool to help you comprehend how certain tax laws operate. It's not private counsel. Always discuss your personal finances and taxes with a qualified expert. Avoidance versus evasion. You must first understand the crucial distinction between the terms avoidance and evasion. Evading taxes is against the law. It entails lying to the government or concealing your income. People are imprisoned for this fraud. Today we are discussing tax evasion. This is entirely lawful. It entails lowering your bill by taking advantage of the current tax laws. You're merely following the rules to save money, much like when you use a coupon at the store. What are the real strategies then? First, wealthy people make money in different ways. They earn money from investments such as stocks rather than a traditional salary. The tax rate on this investment income is frequently significantly lower than that on your employment income. Second, they keep their valuables. Rather, they take out large loans against them in order to obtain cash, which is not taxable income because it is a loan. Finally, they make very clever use of things like charitable contributions and business expenses to lawfully reduce the amount of income that the government can tax. These are merely an alternative method of utilizing the financial system. They are not secret tricks. Strategy number 1 is lower tax rates on investments. How they make their money is the first and most important strategy. The majority of people receive a paycheck from their jobs, known as ordinary income. This is subject to the highest rates of taxation. However, the majority of wealth is earned by investments, such as stocks or real estate that has been owned for more than a year. The profit from the sale of these is referred to as a long-term capital gain. The important thing is that this investment profit is taxed by the government at a special rate that is significantly lower than that of blue income. As a result, they are essentially operating under different tax laws. Strategy number 2 is borrowing against assets. Consider this. You must pay taxes on the profit you make when you sell a stock that has increased in value. Instead, what do the rich do? They are not a seller. They visit a bank and obtain a large loan using their already valuable assets, such as their stock portfolio, as security. They spend their money from this loan. The part that's brilliant? Loan funds are not regarded as income. Thus, they have access to money without generating any taxable events. This allows them to live off of the bank's funds while their investments continue to grow tax-free. Strategy number 3 is strategic charitable giving. This strategy is about using charity wisely. A wealthy individual may choose to donate stocks or other investments that have significantly increased in value rather than cash. They would have to pay a hefty tax bill on the profit if they sold those stocks. However, they gain 2 advantages by giving them straight to a charity. Initially, they do not have to pay any capital gains tax on that increase. Second, they continue to receive a sizable tax deduction for the entire donation amount. As a result, they efficiently lower their taxes while also supporting a cause that is important to them. Strategy number 4 is business ownership and deductions. Owning their own businesses is how many wealthy people earn their living. Business owners are subject to quite different tax laws. Many of their expenses are legally deductible or written off before they are ever subject to taxes. This implies that expenses for running a business can include things like a company vehicle, business travel, office supplies, and even portions of their house. Their taxable income is greatly reduced by these deductions. Therefore, a business owner typically only pays taxes on the money left over after business expenses are covered, whereas an employee pays taxes on their entire salary. Key takeaway: the most important thing to keep in mind is that the game frequently revolves around the kind of money you have, not just how much of it you have. The system incorporates the tactics we covered, such as smart deductions and investing for lower taxes. Even though the scale is different, the first step to managing one's own finances more wisely is to understand these guidelines. Please do me a huge favor and hit the like button and subscribe to Monetive if you found this useful. It greatly aids in the channel's expansion. I would now like your opinion on what financial topic we should discuss next. Please share your thoughts in the comments section below. Thank you for viewing.